The Moolah channel. Today we're going to be talking about 3 or 4 topics that I wanted to get through. I wanted to do this stream a lot earlier, so I recognize attendance is likely to be down just based off the fact that I'm starting this off at 9:45 Central Time, 10:45 Eastern Time. But overall, I'm going to cut this up into multiple videos as always for your viewing pleasure. So first and foremost, I wanted to talk about how I'm putting the portfolio entirely into TSLY and let me tell you why. Because the yield is just so great. There's no full it's foolproof. It's completely foolproof. Let's just say you have a $2 million portfolio, hypothetically, and you were to invest that in TSLY, which if you look on the website, is yielding 69%. You get a guarantee $1.38 million guaranteed. You don't have to worry about principal loss. You don't have to worry about any of these things that would come with investing in a TSLY. And, it just makes sense. Why would I work another day if I could just invest all my money into TSLY? We know that these products don't fail. SLVO, remember that silver ETF that was yielding 35%? We know that one did phenomenally, right? Let's pull that one up. I think that one's still printing money. That was all over FinTwit not too long ago, preaching how great of a yield that was providing. What is it at now? The yield doesn't display the yield, but let me pull it up for you guys to show you. At one point, this is another one of these foolproof investment opportunities that you guys could get into and not have to work another day in your life. This was a huge one on Twitter not too long ago. And here you go, $75. You can see it hasn't lost any principal whatsoever. And I think a lot of people were preaching because I think it yielded like a 35% yield or something like that. And so you could see it started in April 2013. Ignore the fact that this says $412 back in April 2013. That's irrelevant. It yields 35% a year. So in that respect, which I don't even know if it actually does yield anything anymore because it doesn't say anything. Now I'm kind of curious. SLVO yield 21%. So there you go. Great opportunity. I looked it up online. 21% continuous yield. This down and to the right trend is not bad. Ethos Investing is asking if that's bad. That's not bad, right? We're full porting into TSLY. I'll never have to work again. So that's pretty much the stream. I'll call it there, and we'll call it, and I'll talk to you now. But in reality, I wanted to walk through TSLY and why some people might be extremely bullish on this opportunity, and I want to walk you through understanding what's truly into and underlying this. So, and I recommend most people do this entirely if you're looking at investing in ETFs in general. And let's just the first thing I'll share specifically is maybe what you're looking at when you're comparing these two opportunities with, say, an S&P 500 or a just normal TSLA or Tesla investment. And what this is showing specifically, let me zoom in a bit here, is the year to date. We can pull up a year, but it doesn't really work out because TSLY only came out in November or December timeframe. But you just pull up the year to date. Tesla's had a hell of a run this year, 126%, and that's because a lot of the pullback that it's had, over the past, say, 3-4 years or so. And when you're kind of basing it off of this bull run that it's had, from where it was down 30 odd percent up to where it is now, hell of a bull run, right? You would anticipate that such a great opportunity like, let me just double check that I'm sharing. Okay, I am. That TSLY is that it would match, right? And it's confusing. I think it'll be confusing for a lot of people. And I guess it goes back to the question of what are you investing for? Are you investing for income? Are you investing for growth? Do you think that investing in an opportunity like Yieldmax TSLY is going to yield you the opportunity to get 126% year to date returns, coupled with this 60 odd percent annualized dividend income? That's kind of my curiosity for a lot of people. Is that really what you think? And the fear that I have for most people is not even understanding that investing in TSLY, it doesn't actually own any Tesla shares. And I don't think a lot of people recognize that. They're synthetic longs. And so if, say, Tesla decides to go way out west and go bottom seeking, falling knife, it could get really bad very quickly, very similar to what we saw in SLVO. And so, and I'm not lying on that. We're going to go through the prospectus. You guys are going to see. When I pulled up the holdings of the company, a lot of it's cash, and a lot of it's synthetic options that allow you to kind of synthetically match what's kind of going on with Tesla. But the thing that you can see is when Tesla's kind of running, TSLY doesn't match that hype because you're writing covered calls, right? And when the TSLA or Tesla falls, it falls about as much as you would expect Tesla to fall. But then when you think about it and then it goes back into a bull run, you're capped, right? And the reason why you're capped, and I'll get into when we get to the prospectus, is they write on these synthetic shares, these synthetic longs that they have for the options contracts, they write covered calls a month out for 5 to 15% above the money. And so here you are, if you're coming into April into May where you're flatlining, the stock is somewhat down, and here you're having to write for, a couple months out of time for covered calls, then you're writing, into the June timeframe, and next thing you know, you're skyrocketing. So you can't necessarily match the appreciation of the underlying synthetic shares because you're capping your gains because you want that income. It's the whole reason why TSLY was invented. And so with this opportunity, with that kind of start, I will just share the actual prospectus, and then hopefully you guys get a little bit more understanding of what's really underlyingly in this opportunity, and to just take a grain of salt with all these people that are moving into TSLY. And hopefully this gives you a little bit more insight and for yourself to do research, right? So let me share my screen again. Specifically, is it this or is it this? Let's go with this first. So this is the underlying prospectus. And so there's a lot of opportunities. You could literally pull this and look at all the Yieldmax funds underneath. So this entire book here has Amazon. It's got the Meta version. It's got, any of these Yieldmax funds are all underneath of here. And first and foremost, there's a 1% management fee, which isn't that bad. It could be a lot worse considering what they're doing here. It's very actively managed, so in that respect, it's rather cheap. But really, what I want to highlight, and this is something that goes into all ETFs, right? I think a lot of people just assume why they're investing in an ETF. They don't actually read the prospectuses. And I think it's an opportunity for you to learn a little bit about what they have to, as an SEC obligation, provide in their prospectus for people to understand. So why invest in the fund? The fund seeks to participate in a portion of the gains experienced by Tesla. Not all of the gains, a portion of the gains. The fund seeks to generate monthly income, which is not dependent on the price appreciation of Tesla. That is, although the fund may not fully participate in gains in Tesla stock price, the fund's portfolio is designed to generate income. So income first, matching the price kind of second. An investment fund is not an investment in TSLA. The fund strategy will cap its potential gains if Tesla shares increase in value. The fund strategy is subject to all potential losses if Tesla shares decrease in value, which may not be offset by the income received by the fund. The fund does not directly invest in Tesla. The fund shareholders are not entitled to any Tesla dividends. Additional information regarding Tesla is also set forth. So then it gets a little bit into what is exactly going on here, because there, as you see here, the fund is not directly investing in Tesla. As a part of the fund's synthetic covered call strategy, the fund will purchase and sell a combination of standardized ET and flex call or put options that are based on the value of the price returns of Tesla. In general, an options contract gives the purchaser the option contract the right to purchase for a call option, or for a put option, the underlying asset like shares of Tesla at a specified price or the strike price. The seller of an option contract obliges the holder to deliver shares for a sold or short call, or buy shares for a sold or short put of the underlying asset at the specified price, or the share stock strike price. Um, Option contracts must be exercised or traded within the specified time frame, or they expire. Yada yada yada. So, what exactly is going on here? So, in seeking to achieve the investment objective, they implement a synthetic covered call strategy using standardized exchange traded and flex options described above. A traditional covered call strategy is an investment where the investor or the fund sells a call option on an underlying security that it owns. Covered call meaning they own 100 shares of Tesla. They sell Tesla contracts 5 to 10% out of the money, generate a little bit extra income, and call it a day. But a synthetic covered call strategy is similar to a traditional covered call strategy, but they sell a call option that is based on the value of the underlying security. However, in a synthetic covered call strategy, the investor or the fund does not own the underlying security, but rather seeks to synthetically replicate 100% of the price movements through various investment instruments. What they do, the synthetic long exposure to Tesla, which allows for the fund to seek participate in changes up or down in the price of Tesla stock. And they also write covered calls where they're able to generate income. And then they also have money in US treasuries, which is the collateral in the case of something goes wrong with these synthetic long options here. So what they do to achieve this synthetic long option, or basically match the price of going up and down for Tesla, they basically buy Tesla long calls or leaps, or not really leaps. I think they're 6 months to a year out, and this will explain a little bit in a second. While they simultaneously sell Tesla put options to replicate the price movement of Tesla. The call options purchased by the fund and the put options sold by the fund will generally have a 6 month to a year term and strike prices that are generally equal to and the then current share price of Tesla at the time the contracts are purchased and sold, respectively. Combination of the long call and the put sell provide the fund with the investment exposure equal to 100% of Tesla during the duration of that time. And what they do is I'll just say this, the call options written generally have an expiration of 1 month or less, and they're sold 5 to 15% above the then current Tesla share price at the time of such sales. What I want to highlight specifically here is, let's just say, for example, that you have Tesla at $200 a share and it just came off of some massive knife, right? The thought then would be that you write something, let's just say 10%. So you're writing it 220, right? Well, we know Tesla likes to rip 5-10% in a day sometimes. So if that's the case, you're then writing calls that are going to get blown through, and technically you're capping your upside opportunity, which, if you remember that graphic, you match pretty much all the downside opportunity associated with Tesla, or downside risk associated with Tesla in terms of share price decrease. But then when Tesla's going up and to the right, it's lagging severely, which is why, Tesla itself is up 125% and TSLY is only up 7%. So that, yes, I'm waiting for the triple leveraged TSLY, and then I'll probably invest in it. But I'm trying to decide if I should even go on reading this. What we can do is maybe look briefly at, is this showing? This isn't showing. So let me show you, hide, and then show you the holdings that are in here. So the holdings here are where is this bad boy? So they have, are these the long options? So they have multiple sets of long options here. They have a 923, 265, and then they have a 225 October 2023, which is way smaller. They have a lot of cash. So they have about $14 million worth of cash. And then they have about $600 million worth of treasuries, one of which being December 2023, some of which being in November 2024. And so that's the majority of it. And you can see this, if you add both of these up, it's over 100%. But that's because when you write some of these synthetic options, you get cash back, of course. So what they're doing then is they're taking this October 23 225 put or call, and they're writing against it. They're selling a 225 put, which you can see these match, right? The 4,000 contracts basically leap, and then the put sold. So basically what they're doing is they're getting the majority of their money back in this 225 put. So if everything goes well in Tesla, it goes up and to the right, everything will be perfectly fine. And then what you'll see is they write covered calls on that. So they have it at a 225 sort of contract here, and then they're writing it at 245 or the 265. So let's just say, for example, let's just go back and look. I don't remember where we're at, but let's just say within the next year or two, but let's just say within, let me just share my screen again. Maybe I didn't even end up sharing. I didn't even share that. A bunch of different contracts and stuff like that. So here's what I was kind of reporting here is like the differences in the call options that you kind of have. So the positive numbers for contracts, which is the third column, you can see the 600 million or so in treasuries. You can see the long call options here, the 24,000 shares of long calls. You can see the covered calls or the synthetic covered calls, and then the puts that are kind of here. So you can see the 2,400 contracts of put options that kind of replicate the synthetic longs, and then the covered call option here that kind of gives you the covered call piece. So we're probably going to end up buying this back or rolling it out to October if that's the case, and you'll end up having to kind of do that. But what was I going to share with you as well? Oh, just going back to the actual share price appreciation of it. So we're done with that. Let me share this again and make sure that we share. So share price right now is 245, but let's just say we go and run to 300 tomorrow or before October. Well, if you're invested in TSLY, you're kind of effed, right? Because they have 265 calls or 245 calls, actually. The 265s were puts and long calls, right? So technically you're writing 245 covered calls on the synthetic options to hopefully generate that little bit of income. And so if you blow through that, you're kind of effed, right? And so if this is all confusing to you, that's okay. That's understandable. What I'm hoping to do is help you understand that TSLY is not as simple as I think most people on Twitter will make it seem. And so for the folks that are dividend income at all costs, will invest all their money in Walgreens, will invest all their money in AT&T, will invest all their money in these dividend yield traps, which they claim are, oh, there's no way this is a yield trap. Just be cautious, right? And that's kind of the hope that I wanted to implement with you guys, is to understand, before you invest in some of these things that people are shilling online, do a little bit of research, right? Make sure that it's something that you understand you're getting into and it matches with your investment objectives, right? Because you might be sitting here being like, oh, I'm going to get 100% match of what Tesla returns are plus 60% yield. Who wouldn't want that? Tesla's up 100% this year. And so if you think about it, you're like, I'm probably going to make over 160% return this year. It's something that's going to be dividends and I could use that to buy. But at the end of the day, it's going to be eroding long-term principle. And so I think you just need to recognize that, does it fit into your investment strategy? If the answer is yes, by all means. But I think a lot of times people get sold a thing of goods because they want to listen to people that will, talk out of it because it'll be popular because of the 80% yield or the 69% yield that it shows right now. And with that, people will gravitate towards it, especially the people with dividend yield at all costs. And a lot of times those people are smart, but they're not smart enough to recognize some of the risks that are out there associated with things. Now, what I wanted to share again with you guys is maybe more of my top 10 in my particular portfolio. And what you'll see is that it's a pretty large position overall. And I would say, let me just do some quick math here. Okay. It's about 50 to 75% of my portfolio, we'll say. So I won't give exact numbers because I don't like to share a lot of that stuff. But what I will do is be kind enough to share with you guys my top 10. I'll share with you guys my next stream the income that I get because it should be on the order of $100,000 if I full port Tesla or TSLY. But what I want to share with you guys, let me exit out and organize some of this stuff here, is the top 10 positions I have in my portfolio. And hopefully this will help you guys because I think some of you guys think that all I do is invest in, Palantir. And then some of you guys think all I do is invest in other stuff, like dividend stocks and stuff like that. So I have a wider range of different positions. So just on here, I have the stock, the ticker, the name. This isn't real. So let me just erase this. Unidoc Health Corp. The price of the stock, how many shares I have, market value, approximate annual dividend payout, and dividend percentage. Now, the only one that I don't really share everything with is UDOC, which is an undisclosed oil company that I work for. But you can run some approximations and maybe figure out if you really care. I just try to dissociate with my YouTube channel and the company I work for just for, HR reasons. So let me just double check that I'm sharing everything on the screen and we can kind of talk through a little bit about it. And hopefully we can get to, after that, some Q&A associated with the portfolio. And hopefully this is insightful for you guys. So SPY, I don't have all this in my individual brokerage account, but what I did is I combined my individual brokerage account and my 401k holdings. And so you can kind of understand a pretty good part of my portfolio, about 300 grand or so, is in a SPY or SPY equivalent. And so with that, I'm really hoping to get to, specifically in my individual brokerage account, $1,000 a quarter. Now I'm not there, probably close to 600 a quarter in my individual brokerage account. But if you were to include what I have in my 401k coupled with what I have in my individual brokerage account, you get about 4,300, 4,400 a year in dividend income, which I'm pretty excited about that because to me, this is something that's just going to continue to snowball. And I like the S&P, and I think it's a very well managed index fund, just based on the fact of the rules that's been set up with it to make sure that everything's kind of always prospering. And even in down times, you're focusing on the companies that are mostly prospering and not getting hurt here. So the equivalent shares of this is 674 SPY. But like I said, not all this is actually SPY. Some of it is 401k sort of mutual funds that the company has set up. Then you have UDOC. That's my number 2 position ever since Palantir kind of dropped back below, say 1950 or something like that. And so I just have this position in here, just based off of share-based compensation that I get, and some rewards that I've gotten over the past several years. And so hopefully that'll vest. Majority of it will vest in 2025, and I'll probably keep some of it, but maybe invest some of that into some of these other positions here. Now, not all these are in 100% order because sometimes I have multiple positions in different accounts. And so, like this TQQQ in here, this is kind of like a uh, F it sort of like 5%, 4%, whatever percentage it is. Like if it ends up performing as well as it has over the past 10 years, sort of thing, then I will continue to succeed and the portfolio will do extremely well. If it doesn't and it goes to zero, it's what, 64 grand or whatever. So that's a lot of money. But at the end of the day, it's really not going to hurt too much. And so that that'll be that. I mean, it'll be one of those things where it's like it kind of sucks, but it's not going to really make or break me, right? Then you have at number three, kind of the pound tier, or I guess this is technically number four, pound tier. And this one, goes back and forth between number two, number four, because of the volatility of it. But it's about $60,000 worth at the moment. I would want to potentially look at investing more, maybe getting it to 5,000 shares over the next, say, year or so. But I think a lot of that depends on what comes out of Q3 and the client growth associated with it. I've been rather disappointed with the growth rate coming from Palantir, and I try to think big picture. Like there was a lot of, I think, money coming in, or potential money and revenue coming in from the CDC deals and the vaccine rollouts and stuff like that. And I anticipate there was some money associated with it. I assume maybe it was done for free, but I think associated with that, if that was true and there was money associated with that, is kind of on the decline. And so with that large piece of revenue coming off the decline, you're offsetting that as you try to get more and more clients, right? So it's going to be a huge big hole in your revenue book that you have to kind of keep in line. But anyway, then moving on to Shell. So I'm big in the oil and gas industry, as you guys know, and I like Shell a good bit. I work with them quite often, and I think that they know what they're doing. And I also believe in their long-term strategy associated with the transition. And so they have a lot of different pokers in the fire with respect to solar, wind, and many other opportunities out there as well. And so have about an 800 some position there, and I hope to eventually get that closer to 1,000. Getting a screenshot. Oh, I thought you meant screenshot and you're dipping. And then I also talk good amount about Google, Amazon. Those are ones that I truly love. Those are hoping positions that I can get closer to 400 shares by the end of the year. But I'd have to probably sell some stuff in order to do that. So that's really that. And then JEPI is an income fund that mostly focuses on like 30 or 40. Maybe it's closer to 100 actually. Or maybe I'm thinking of Devo. Different stocks that are in the S&P 500, but aren't necessarily 100% technology focused. So it's a different way. So it's kind of like a QYLD or an RYLD or an XYLD, but a little bit less focused specifically on getting entirely income. So they're a little bit more laxed. Granted, this was only like a 5-6% yielder not too long ago, and it seems like they've kind of focused more on the dividend yield rather than focusing on long-term growth, which I didn't really invest in it for long-term growth, but I invested in JEPI more than like an XYLD or something like that, because I was hoping it'd be more balanced. And it's the same reason why I invest in XYLG as opposed to XYLD, because it focuses a little bit more on balance of a little bit of income, but focus on, investing in the S&P and then only writing covered calls on 50%. of the opportunities. And so I might relook at investing whatever here is in Jeppy into XYLG. So that's something I might consider. And following on with that with Devo is like 30 to 35 individual positions. That's done relatively well. And this is another one where I might potentially look at putting it into XYLG and then just kind of combining everything. And that'll take a huge hit to the dividend income overall for the portfolio, because I think it will be closer to a 4.5% dividend yield comparatively to, say, the almost 9% that you're seeing from Jeppy at the moment. But the portfolio, as I get older, and as you can kind of already see here, decent amount of dividend income. If I need to switch these to strictly dividends to pay for bills or something like that, I have that opportunity. But for now, to me, it's more about long-term focus on capital appreciation, so I can use that to either create a business in the long term, real estate, what have you, provide that optionality. If I need to get the dividend income, I can get the dividend income by moving things into higher yielding positions. Um, and then following that up with Pepsi. Pepsi's one that I'll probably continue to shrink. It's not that I dislike Pepsi. I just don't, with where it's at now, it's richly valued. But it always is going to be paid for a premium because it is such a good product, specifically with their snacks line as well as their beverage line. So you like Doritos, you like Lay's potato chips, or you like Frito Lay, you're unknowingly buying Pepsi products. So I think that they do a good Gatorade as well. So you like all those opportunities and brands, then Pepsi's your kind of guy. But because of what has been going on, Pepsi's had a pretty good price premium associated with it because they've done really well in their pricing power post pandemic and even during the pandemic. A lot of people were buying their products for snacks and stuff during the pandemic, and they've continued to grow revenue, 7 to 8% year over year. And so if you couple that with a good 25, 30x sort of price multiple, of course, you're going to get a pretty good price on the company. So to me, it's, buy low, sell high, right? And as much as it would suck to get rid of Pepsi, I think it has a good runway in the long term. I just don't see it really overperforming the S&P 500. And so if I have the ability to eliminate that single stock risk and either put some of that into SPY or calculate it into something that has a little bit more medium term risk, but has much higher potential to double or triple or quadruple or quintuple, then I'd rather take half of the money in Pepsi, put it in the SPY, and then find a focused company that I can kind of look through some of the risks and mitigations. And actually, this holding here is a little bit wrong. It says I have 214 shares. I only have 200, and a part of that money that I had actually went into Dutch Bros. And I did the same with Johnson and Johnson, which I think was the 11th position in the portfolio. It's about comparable with Pepsi. So I sold both of those. I've been reinvesting all my dividends into Pepsi and J&J and not really taking them in cash. And with that, I was able to establish a, I don't know, $4,500, $5,000 position in Dutch Bros. And that's the sort of talk that I want to bring to light, which is Pepsi's a great opportunity. I think it's a great place to store capital if you need it, and it pays a decent yield, close to 3%. But is an opportunity like a Dutch Bros, looking, maybe not necessarily right now, but looking in a quarter or two, once they get EBITDA cash flow kind of break even, where right now they're focusing very heavily on store openings, but with every store they get more revenue, and with more revenue they get more EBITDA. So they're getting closer and closer by the day to being kind of cash flow break even from an EBITDA perspective. And so it's something to look at. And to me, once that kind of happens, and once their roastery opens in Dallas, it's like, okay, now it's nut up or shut up time, right? Like the risk has kind of been eliminated. They're not continuing to just spin their wheels, right? They're cash flow break even now. So they don't have to go to the market at, say, 10, 15% to be able to fund their future growth, right? So, and they're pretty well capitalized. I think they have like 500, 600 million in revolving credit or in cash before they really need to go into into kind of like further debt seeking mode. But to me, any company with kind of cash flow break even is something I look forward to. So I wanted to share that with you guys because I think a lot of people kind of get a very weird taste of about what I'm investing in. It just goes to show you a lot of these things are hangovers from what I was investing in prior to the pandemic, and some of it is kind of hangovers to the portfolio literally tripling since that point, or if not more. I went into the pandemic 2019, 2020 with like less than half a million. And coming out of that with continued contributions to the portfolio, living overseas and living on, basically the company's dollar, being able to invest a lot of that money instead of like blowing it on trips or drinks or bars and stuff like that. I invested a lot of that money. And coupling with the rebound that we had in 2020 and 2021, and then the slight retracement in 2022 with the kind of resurgence we've had in 2023, the portfolio is very healthy. And one thing that I haven't really been able to do is entirely rebalance the portfolio per se. And so it's been a while since I've shared the portfolio, and it's been a while since I've kind of shared big numbers. So that's just the top 10 positions. And I think that accounts for close between like 50 to 75%. I'm not 100% sure. And it also depends on if you include certain other company benefits that I get, if you include real estate holdings, you include stuff like that. So it gets complex once you have a little bit of other stuff. But in terms of strictly like stock holdings, it's probably close to 50 to no, sorry. It's probably closer to 60 to 65% of the portfolio is in those positions. If you start including other things, it's probably closer to 50%. So, with that, I'll open it to a few questions, and I already see a few. And I don't intend to take too long, as you've already heard. We've kind of been going on for 37 odd minutes talking straight. And so, with that, I'll probably scroll up to the top and hopefully click through some of these that I see here that I think are reputable and good ones. Let's just see. Is Yieldmax a scam? I don't think it's a scam per se. I think it's just people might be confused as to what they're actually getting and thinking that it's going to be better. But no, I don't only invest in Palantir. I wish I had the cojones to do so. If I was aggressive dividend investor sacrificing growth for income at all costs, I'd much rather choose a bond equity focused, lower risk closed end fund, PDI, PTY, ASG. I agree. I think that's going to be more balanced for people in the long run. Question on whether or not I automatically invest dividends. The answer to that is mostly yes. There's been a few cases where the answer to that is no, and that's on an individual to individual basis. But I'd say right now, I'd say yes. I think yes. Yeah, I can't think of any positions that I don't automatically reinvest the dividends on at the moment. Good evening, good evening, good evening. Thoughts on best places to park cash? This is a really good question. And I think we're in a different place than we were a year ago, right? I think a lot of people are still like thinking about how you couldn't use savings accounts a year ago. And now you literally can buy 13-week, 26-week treasury yields. And with that, you're getting 4 to 5% yields compared to a year or 2 years ago. You weren't able to get any money. So I think that you could use that to your advantage. And I think that a lot of you could even use, like I use for my savings right now, I'm saving up to buy a personal residence, and I'm probably going to pull the trigger on that if I can kind of get the right numbers that I want. But right now, I just use Amex personal savings. I think that does well. Fidelity, even if you have a money market account through Fidelity, I think they're offering 4.95% in the money market account. So that's a good opportunity right there. And I think that if you're just looking at cash, I think a lot of people are just like, oh, I need to invest it. It's like, hey, man, if you think about it, on any given year in the S&P 500, you're going to be up anywhere between 30% and also down anywhere between 30%. And so, but on average, over the past several decades, it probably close to 8 to 9% returns. But that comes with a risk, right? It might go up 30%, it might go down 30%. So if you could take a risk-free 5%, I think that that's better than anything. And it also depends on when you need the money, right? So if you need the money in the next, 2-3 months, then it's not worth the volatility risk of losing it in the stock market. So you can't go wrong right now with an Amex Personal Savings or a Fidelity APR. Even Robinhood Gold, I think, offers a pretty good interest rate as well. What is my price target on Bros? I'm okay overpaying. I don't mind. I think that for right now, even a $30 price target, it's too much. I would say I would start backing up the truck if it got down to like $20 a share, as long as the financials are continuing to go in the right direction. I'm going to acquire slowly at the $25 to $30 range, but I would probably go pretty aggressive if things are continuing in the good way, meaning like they're continuing to open up stores, revenue's going in the right direction, and EBITDA is going in the right direction. I would continue to buy, screaming buy at 20, as long as things are right and there's not a reason like some sort of lawsuit or something like that. And I would probably be writing puts. I'll probably I have $30 puts that could probably continue to roll, and I would probably take acceptance of them at 28 to 27.50, and hoping that I'd get my cost basis down to the $25 range. That's kind of where I'm at. So I wrote my 30s, and the cost basis of that would be 28.50. So I think I wrote. So anyway, I think those are September 15s. So I'll double check that. I have to double check, but if that's the case, I'll probably roll them down to 29s or 28s and let them get expired in the money once they get to the $25 range. So, have you used AI to automate code? I don't know specifically what you're asking, so I'm just going to say no. 4.9%, man. Robinhood APY. Let's see. What did you consider? Oh, I did see that you wrote this on Twitter. I didn't mean to ignore it. I was just on the road and in transit. I wasn't actively. I was just looking briefly. Franchising is a little different, which is positives and negatives associated with it. So I think they were slowing down a little bit on the franchising model associated with Dutch Bros. And I think you need to have previously worked at a Dutch Bros to be able to open up a franchise. And so I personally couldn't open mine unless I decided to work for them for a little bit, which probably isn't too dumb. Like specifically if I like get fed up and just need like a little bit of a job when I'm kind of transitioning careers, it's probably not a bad idea to do in the East Coast. Maybe like go live somewhere for a couple months, work for them, and then eventually open one up. That's actually something I might consider. I think you need 500,000 net worth, 300,000 liquid kind of assets, which I have, and then a bunch of other things. So it's not a bad idea, but I would want to. I don't know how they would do it with a company store. So they're doing a lot more company stores now than franchises. But even the franchises make a good amount of money for them. I think like while the franchises, I think for all the fees and everything, they were getting close to like 300 to 350,000 franchise fees a year. So I thought that was pretty awesome. And then their normal stores make like 1.7 to 1.8 annual unit volume, which is pretty good as well. It's better than Starbucks, but Starbucks has a lot more frequency, right? And so they're looking at it from if we have more stores, yes, you get less AUV, but maybe your margins go up a little bit. I don't really know, but that that's something to kind of consider. But I'm very bullish on Dutch Bros. I think that they'll continue to do really well. I'm just going to focus on their net margins, really, because if they can keep that up and they can keep up the 1.7 to 1.8 million annual unit volume, then as they expand into the East Coast where population density is a lot more, I expect that to continue to do really well. And with that, if their net margins continue to be high 20s, low 30s, then they're going to do about almost, I don't want to say almost twice. They're going to do 50% better per store. That's wrong. Their annual unit volume is going to be about double what a Starbucks would get, and their net margins would be about 40 to 50% more. So per store, they're probably getting twice as much revenue, income per store. And so if you think about it in that perspective, they don't need to have as many stores as, say, a Starbucks does. They would only need half as many stores as Starbucks does to get valued at the same valuation, all things kind of being considered equal, except for what I said, which was net margin and annualized unit volume per store. So if you think about it in that perspective, 4,000 stores would almost be the equivalent of 8,000 Starbucks. And so 4,000 Dutch Bros, would be the equivalent of 8,000 Starbucks. And so that's where they're trying to get to in the next 10 years. And so if they continue to do well, I could see them upping that. The problem is right now that I see is they have about 130 to 150 stores a year that they're opening. And to get to that 4,000 range, they need to get closer to 250 stores a year in the shorter term. So what I anticipate is they're probably going to only do 150 stores until they're EBITDA break even. And once they get to EBITDA break even, I think they're going to increase the amount of stores that they open. So I think you'll start seeing in the next 2 to 3 years the amount of stores increasing to closer to 300 per year as the EBITDA break even kind of continues. Sorry. Wreaking Steve on a good dividend. The SCHD is 17% undervalued and almost offering 18% annual return potential over the next 5 years, 123x. I wouldn't necessarily know. SCHD has done some interesting things with a lot of the companies that they've switched in. And so you can't take the previous results and project it forward. I think it all just depends on really what your income needs are, right? If you could survive off a 1.5% dividend yield, I would go with the S&P 500 over an SCHD. SCHD doesn't necessarily mean that the company is profitable, right? I think it has a specific income threshold. And so you might unintentionally be investing in unprofitable companies by investing in SCHD versus if you invest in a SPY, that those companies are profitable because that's in the guidelines of the ETF, right? Or the index fund rather. So it all just depends. I'm not saying SCHD is bad, right? But I think it all really depends what the objective is of your portfolio. Like if you don't need the 3-something% yield right now and you just need growth, then I would look at whether or not you think the S&P 500 is going to do better. By investing in SCHD, you'd probably have less technology exposure, which could be good or bad, right? Depending on what your objectives are and depending on how you perceive volatility within your portfolio. So just think about that. And make your decision, right? I can't tell you whether or not that's the right opportunity for you. I know some people like it because it's got the higher dividend yield, but I also know a lot of people that are buying it in their 20s and 30s and they don't need the dividend yield today. So yeah, man, the whole portfolio TSLY only. That's a good thing. Also the good thing, I didn't go too much in depth with it. Having previous employees being future franchise or company operated sort of store managers means that you're not going to have some dickhead like myself. Let's just make a spade, come in looking just to make money and completely destroy the culture. And so the thing that was very positive when I listened to the earnings report, and I've seen throughout several investor reports, is they're very much about keeping the culture throughout. And like, for example, I went today, I went to a showing at one of the houses, and it happened to be nearby one of the new Dutch Bros that opened up within the past 6 months. And they were just blasting local music, like local Houston music. And it wasn't like super profane rap music, but I mean, some people might think it is, but it was just like local, Mike Jones, like, and I was bobbing, they were living the dream in there. And the product was just awesome, and another thing is just like some of the things that I want, like energy drinks and teas and stuff like that. Like I got a tea from Starbucks earlier because I was driving around all day and I just wanted to make sure I had something to sip on, and I just didn't like it. And then I got a tea and an energy drink equivalent from Bros because I was like ending the day and I was like, oh, I need to make a 25-minute drive home and just grab this, and loved it. Like I slurped it down way faster than I should have. I wish I enjoyed it a little bit more, but it was just so good that I was just like, every single one of those energy drinks that I have is just phenomenal. And like I've had 3 or 4 different versions of it now, and I'm just obsessed with it. And I can't get something like that at Starbucks. Like maybe I could, maybe I just don't know what to order. But everything that I get at Starbucks is very much coffee based, and you can get more juices, teas, like milkshake sort of stuff at Dutch Bros, right? So it all really just depends on what you're into, and you can get coffee flavored stuff too. It's not that you can't. So it's not everything is 100% coffee at the Bros. So there's that. Plenty of competition for Dutch Bros. Thinking growing Dunkin' Donuts sized business a bit more attainable than the next Starbucks. Yeah, man, I think you've seen that or said that on a few comments as well. Um, I don't disagree, but at the same time, when your margins are 50% better than Starbucks, who's to say, right? And they have capital, and we'll really see what the opportunity is. Another thing is like Dutch Bros isn't really about a sitting sort of internal establishment, right? Like Starbucks, like you can go there, you can sit for a couple hours, and really, waste time and use their internet and stuff like that. Dutch Bros doesn't really have that sort of footprint, so the footprint's a lot smaller. Um, so all very, very dependent, right? And I guess it all just depends on what you're looking for and stuff like that. Cultural, yeah, great breakdown. Have I watched the Bernie Madoff show on Netflix? I watched part of it. I didn't watch all of it. So yeah, I anticipate you're talking about Dutch Bros here. The EBITDA is growing pretty rapidly. It's about $200 million a year if you kind of forecast out. And so considering it's going to be about 200 million a year going forward, this is before they open any more stores, and their capex is 225 to 250. I'd anticipate by year end they're going to be kind of EBITDA break even. Now, of course, that includes, that's not net income break even, right? Because I think some people are really concerned about that compared to EBITDA, but I would say so. They talked a lot about this on the annualized unit volume shrinking, because if you go into a new area, right, and Houston's a really good example, because if you look at Houston, they've put in a lot in the outer skirts, and instead of doing like it's like really cool because you start thinking about it almost in like petroleum engineering terms, because like if you put so many wells close to each other, you're going to invade and kind of like they call it infilling, which is like you're going to be invading all the other wells' personal space, right? And if you put wells at a certain space away from each other, they're going to be accessing more opportunity. It's the same thing. It's kind of cool if you look at it from like a city penetration perspective. If you put 16 Dutch Bros all around the city, like in a ring, versus evenly spread throughout the entirety of the city, your annualized unit volume is likely to be less. And so I'm not 100% sure as to why they chose some of the regions, because there's none in like downtown. Um, um, there's no, yeah, there's no Dutch Bros in like downtown or even on some of the major highways. They're all on some of like the secondary highways and stuff like that. And I'm not sure if they do that because of ease of not having to go through traffic and stuff like that, which I've kind of noticed is like everything's coming from Seattle, right? Everything at the moment, like the roastery, the beans, stuff like that, they're all coming from Oregon, Seattle area. So being on specific highways is going to be more beneficial than coming off of other highways, depending on where you're coming from and the transport. So that's one thing to say, but that might change when the roastery opens in Dallas in 2025, 2024, because that's a whole new set of highways to kind of get out of town, and that might open up more avenues for anything. But anyway, yeah, if you put two Starbuckses or two Dutch Bros right across from each other, you might increase the total volume that you get from the two stores or a single store alone, but it's probably not going to double, right? And so they kind of said that a little bit. It's like they expect stores in new areas to be about 2 million, but as they infill, they expect the stores to be closer to 1.5 to 1.7. And so what they saw was Houston, initially the stores that they were putting in very early on were like 2 to 2.2 million. And as they put more and more stores closer to each other, it's kind of brought it down to closer to 1.7. But the annualized unit volume I see anywhere between 1.7 and 1.8. And so as you access more of like the eastern coast, those stores I assume are going to go through the roof because the population density is really good. So I assume some of those stores will be 2.5 to 3 million. Um, and the reason why I'm not trying to attack a Starbucks right now, it's just Starbucks has 30 some thousand locations. Sometimes I've literally seen where there's three Starbucks within a quarter mile radius of each other. There's one's in a Barnes and Noble. There's one on one street corner, one on an opposite street corner. So literally within a 1 minute walking distance, you could hit all three. And I remember one that hits me specifically because I was studying for the fundamental engineering exam back in 2013, 2014. And the guy was like, "Oh, you know the Starbucks on West Gray?" I'm like, "Yeah, sure." So I go and he's like, "Nowhere to be found." And I call him. He's like, "No, the one across the street. I saw you walk in." And it, like, it's literally two Starbucks literally facing each other on the opposite side of the street. It was pretty intense. There's a Barnes and Noble's literally a 20-second walk from there, which had uh, uh, a Starbucks in it as well. So it's like when you think about it, it's like you're kind of fighting against each other at that point. So pretty funny. So yeah, I think it'll soften as they grow, but that's the thing is they're going to continue to go eastward. So I think for now, I anticipate a 1.7 million asset unit or annual unit volume until they get into all the East Coast sort of areas. And then once they start infilling, I anticipate it'll probably go down to like 1.5 or something like that. But I think right now they're so scarce and they're looking at implementing into new markets that for now, I'm going to assume a 1.7. But the net margins are what really, the operating margins per store are what really are driving me to kind of pique my interest because I don't think you're getting the same sort of operating margins as a Starbucks. So you're getting better. So, yep, exactly. It all depends, man. I wouldn't say it's a higher dividend per se. I mean, it's all S&P 500, but VOO. The problem with VOO is, and this might be short-sighted versus long-sighted. So it all fits into whoever the eye of the beholder is. But if you're writing covered calls on VOO absolutely is horrendous. You're not going to get nearly the amount of strikes. You're not going to get nearly the amount of expiration dates. So for that additional, what, 0.06%, or $6 a year on $10,000, I'm pretty sure maybe it's $60 a year on $10,000. I can make that up in terms of covered calls pretty easily. And so it all is in the eye of the beholder. If you're just like a hands-off kind of guy, you don't want to do any covered calls, then for sure, like um, don't don't invest in SPY. But for me, I write covered calls pretty frequently. So how do you personally determine whether a long play turns into a short-term trade? Let's say in Palantir, does the long play become too long? I have a number in mind. Like I have an exit number in mind. Um, and so let's just say, for example, my exit number for Palantir, let's just say is $100 a share. And so at the 2 billion shares, it goes to $100 a share. That's a $200 billion market cap, right? So if it gets to something like $100 billion market cap tomorrow, where it's trading at $50 a share or it's trading at $75 a share, and I really was honestly thinking about selling it at $100, then why wait the extra like 10, 12 years, right? For it to grow into it if you get the opportunity first. So it all just really depends, right? And you can't like you can always make a plan as to when you think you're going to exit, but is it ever going to come to true fruition like that? Who the hell knows? The company could always go bankrupt too, right? I mean, so I do think about that a good bit. Like when 2021 came around and I had um, like 1,000 shares and it went to $45. So I was just like, oh shit, should I sell? But I was just writing covered calls and I made a crap ton of money making, buying those covered or selling those covered calls. So, um, to each their own. And I'll probably end up doing the same. Like if it continues to grow, I'll just continue to write covered calls, try to get as far out of the money as I can, but slowly, accumulate a couple percent here and there. And I think it's just all into the eye of the beholder, right? I mean, I'm a long-term guy. Long-term for some people might be a week, like so uh that's the thing. It's like not everyone's perspective is the same. Long for my brother-in-law is like probably a couple hours. So it it all is into the eye of the beholder, and that's when you kind of have to take what anybody says on YouTube or what anybody says on Twitter with a grain of salt, because like I'm a long-term investor and they might be talking about 6 months from now, or they might be talking about swing trading versus long-term investing. And so when you talk about swing trades, a swing trade might be anywhere between 3 to 6 months. And so when they say long term, they might be talking about 3 to 6 months. When I say long term, I'm probably talking about 10 to 15 years. So it all just comes to like understanding when somebody says something, they say it from their perspective most of the time. And so that's part of the hard part of interpreting what anybody says on Twitter, what anybody says on YouTube. Unless you truly understand this person's perspective, investment style, you can't directly apply it to you, because that person's perspective or investment style might not be at all what you are. And if you think that that person has the same objectives, like you're probably wrong. Um, so if you ask them what number they wanted to get to before they retire or retire early, they're probably going to say a different number than you, or they're going to say a different way to get there. They might say that they want to get there through capital appreciation. One of them might say they want to get there through dividend income. So that's that. Why diversify out of TSLY? Zero risk, offers incredible long-term returns. I agree. It's probably the best opportunity on the market. Um, I'm expecting with my portfolio to be getting at least $100,000 a month in income. And so, the next time you guys see me, I'll probably be on a yacht. Um, so Dividend Sensei is good. I like a lot of what he says. But SCHD over the past, I think, like 5-6 years has actually beat the SPY, but who knows? Let's just see. Let's see. Oh, see, man, shit. I saw the peach and I was like, I think I need it, but I got the astronaut instead. The astronaut was a good time. So now I've tried like the lime blueberry, the blackberry pomegranate, and the astronaut, and they're all really good. Understand your point of view. With so many USA largest food companies are hitting major lows each week. Um, yeah, so you're noting Campbell's, Kraft Heinz. These are all consumer staples, right? These aren't specifically um, restaurant companies or anything like that. As far as I can tell, GIS is General Mills. I don't know who CAG is. So you're kind of comparing apples to oranges, right? No? Like I think the biggest competitor would be Starbucks and maybe some other restaurants. And as far as I've seen, some of these restaurants are really doing well lately. Texas Roadhouse, a few others. So to tell me like Kroger is doing poorly, so Dutch Bros is going to be doing poorly. If I'm following, I think is a pretty weird statement. Or I don't know if you're because your next point is about dividends. So sorry if I'm like misunderstanding. I thought you said something about the Bros earlier. All these pay great dividends and are still selling off. Another correction could be happening unless the company is debt free. Uh, no, I'm not smart enough to be a software engineer. I'm a petroleum engineer. Uh, you're an older man, was taught at a young age any type of market, and even in recession, like food companies are recession proof, but people don't care by selling these off when people must eat. Yeah, I mean, the fact that's another thing, right? Is you're looking at companies that are generally speaking very mature, right? Kraft Heinz, Campbell Soup, and once again, I'm going to relate this back to the Bros, Dutch Bros, or even Pepsi, right? These are more, Pepsi, um, Campbell Soup, General Mills. Those are all mature companies, right? So I think that they'll hold their value. They'll match inflation, right? Of course, with all that, and be able to continue to kind of price and optimize price through inflation and optimize efficiencies and buy back their own shares and stuff of the like. So I anticipate them keeping up, if not slightly underperforming the market. But I don't see any of these magically 3xing or 4xing from here, right? And so when you look at the Bros, that's a company that has yet to mature, um, and the opportunity set of them being able to grow from 600 odd stores to 4,000 is is pretty good, right? I don't think you're seeing a sort of growth trajectory like you would at say a Kraft or a General Mills or something like that, right? I don't think they're going to increase their volume that extensively. So that's kind of what I'm referring to as like looking at and kind of adjusting where you're investing some of your money. Maybe I'm misinterpreting what you're saying, but that's my thought process with that. Um, and with respect to being older, I respect that, and you're probably someone that's looking more towards a dividend income. Um, anyway, uh, volatility of Coinbase is 85, I believe. It will pay more than TSLY. Yeah, I'm not a big fan of any of those Yieldmax funds. Dude, yeah, why buy anything? They're all going to $100,000, and yeah. Um, how soon do I think Palantir will go to zero? Probably tomorrow. Um, actually, the price might be flat tomorrow, considering the market's not going to be open. Yeah, always need a time frame. Might have to drive into Riverside to grab a Dutch Bros tomorrow. What flavor are we trying? That's a good question, man. Up to the beholder. I'm a peach guy. I like some of the people really like the rainbow stuff, the rainbow. Um, some people like the Bob Marley, like GW. Retire with Less really likes the Bob Marley. I didn't think it was bad. I just, I like if I have coconut, I like being like a daiquiri or something like that. I'm not really in like a coconut coffee kind of guy. Um, well, I hope you do well, Join John. I just don't think in 10 years' time they will be doing as well as you anticipate, meaning the Yieldmax ETFs. I'm fairly certain they will not be doing as well as you anticipate. Um, Yeah, I would give the energy drinks a try if you're into that thing. Like if you like monsters and you like, Rockstar energies and stuff like that, the Rebels are really good and they don't have something like that comparable. I'll ask my buddy SG. He just came into the chat. If Starbucks has that equivalent of like those energy drinks. So um did well on John Deere stock when the market crashed during COVID. Using the logic, people still need to eat and farmers will still buy tractors. I agree. I mean, any stock did really well. Well, not any stock, but majority of stocks did well. Uh, because the market sold off very abruptly. Do you use puts as a hedge? I don't. Chris and I talked about that on a previous Cash Flow Chronicles where we were kind of talking about using hedges um, for portfolio drag and being able to kind of wait for some sort of black swan event. And to me, I don't get it as of yet. Maybe eventually when I get to that point of having such a large portfolio that I'm okay with it. Just how do I say this? I'm okay. Like right now, I'm trying to grow the portfolio, so I don't want to lose any percentage of growth towards drag, meaning taking a percentage or two of the portfolio earnings or portfolio percentages, putting it into puts in the hope that there might be some sort of downswing. To me, I'm okay with holding the volatility. And maybe in the future, if I had, say, a $10 million portfolio, which I'm pretty far away from at the moment, but if I had that, maybe I'd be more intrigued in, doing a little bit more hedging associated with it to offset any potential losses and make sure that I maintain a certain portfolio value or something like that. Am I late to the party? No, my guy, you're doing great. Never late. Let's just see. They have some energy drink in 12-ounce can that they're like berry LaCroix flavor, shocked at the size of the Dutch Bros energy drink. Very flavorful. Yeah, very good. Well, I have been going for about an hour and 15. I'll answer any few more questions you guys might have. I recognize it was a rather tight knit group because I came on a little bit later than expected, probably, and it's a Sunday night, so some people might be getting ready for tomorrow. But other than that, I might wrap it up. Wait for another question or two to kind of come through, and then call it. But as always, appreciate. Yeah, I understood the Starbies. Starbies. I had the green tea lemonade today. Not a fan of the green tea lemonade. It was really disappointing. You'll be living in the Philippines around December. Subscribe. Well, I hope you find better opportunities than that to invest in, because I don't think that the principal will do well for you if you plan on living in the Philippines for long term. But I could be wrong. I could be eating my words. I don't think a lot of those opportunities will stay flat. I think with the volatility of some of those positions, they'll either underperform or go negative in terms of value, personally. But all the best to you. I really don't want anybody to do poorly in the market. So I really hope that I'm eating my words and you do really well with that opportunity. But okay, well, hopefully you guys learned a lot about talking through Yieldmax and looking through the prospectus, not only specifically for TSLY, but just in general, right? And looking at specifically how, when you're investing in a new opportunity, to look at the prospectus and understand whether or not it fits into your specific objectives, right? You obviously wouldn't be wanting to invest in TQQQ if you need dividend income, like our boy Join John over here, and you obviously wouldn't be wanting to invest in, say, a Yieldmax or even an SCHD or a JEPI if you're looking for total returns and capital appreciation, right? So just kind of keep that sort of thought process when you're looking at prospectuses and trying to get yourself in the right direction. I hope that you guys were able to see a little bit about the top 10 positions in the portfolio. Hopefully it was enlightening for you guys. $18,000 specifically from dividend income from those 10 positions alone. And there's an allotment of other positions in the portfolio that generate income as well. And the thought process around really focusing on more long-term price appreciation, and focusing on that in the top 10 rather than dividend income, as I do continue to plan to work for the next several, probably 5 years or so, into the mid 30s, and continue to grow the portfolio in that perspective. And then just talking through some of the questions, I really hope that you guys learn a little bit anytime I have the opportunity to give you guys any sort of insight. Now, of course, as always, it's my perspective, right? And I try to be calm, and I try to provide a range of thoughts, right? Whether or not you're focusing on it from a specific lens, and really hope that that hits home, because I think a lot of times people come on and they talk with such gusto and confidence. And I think one of the reasons why I don't get as much love here on YouTube is because I try to provide a different perspective. Like, people just want tickers. They just want like a yes or no answer. They want, like, basically don't want to do any work. And unfortunately for me, I just don't have that sort of bone in my body to just openly lie to you. I really want to make sure that when you're looking at some of these opportunities, you have the opportunity to truly think through it. And if you don't, I'll be the first person to tell you to probably just invest in the SP 500 and walk away. And so, that's way I like to approach. I like to help teach you to fish rather than give you the fish, because most of the time when people give you fish, they're really just giving you kind of the bones. They're not really even giving you any of the meat and the actual fish meat that you can eat. So, um, anyway, that's the end of it, and hopefully you guys enjoyed. And I think that Chris will be back this week, so hopefully, while we took off last week for Cashflow Chronicles, we'll be back this week. So I will probably download this opportunistically when I have some time tomorrow, and cut up the video into probably 3 different pieces. But anyway, cheers. I'll talk to you guys soon.